All right, so we're going to take a look at the FRQ 2013 here. It says, assume the United States economy is operating at full employment. Okay, so we have one that's not in a recession now. We were at full employment. So to show full employment, that we're going to be at equilibrium. So drawing this on the ADS graph, remember the intersection of your short run aggregate supply line and aggregate demand line, it's going to intersect along the LRAS. So to show equilibrium means our current level of output, the intersection of AS and AD, is at your LRAS. Now this could have been an F, you could add YF, and that works out just fine, showing that your current level of output is at your potential level, that LRAS. All right, now let's take a look at B here. Assume that personal savings in the United States increases. Okay, so there's more extra money. People are having that extra money. Using a curriculum-labeled graph of the loan funds market, show the impact of the increase in personal savings on interest rates. So if people have more extra money, there's increasing the supply of loan funds. So remember, supply of loan funds is extra money. You can increase supply of loan funds if people have more extra money, or if governments have more extra money, maybe because they have a budget surplus, or if foreigners take their extra money and dump it into our economy, maybe because they're seeking the higher rate of return because our economy had higher interest rates. But this is personal savings, so we're going to see that people are taking their extra money and dumping it in here. Remember, if you get a loan that's for real, we have you have real interest rates for loan funds, real interest rates. So supply of loan funds increases, it's going to be shifted right. When there's an increase in supply of something, it should now cost less to get it if there's a plethora of it, if there's a large supply. So interest rates will decline. Based on real interest rate change, that was going down, interest rates went down. Will interest sensitive expenditures is just a fancy word of spending, increase, decrease, remain unchanged. So if interest rates go down, it's cheaper to borrow money. People and businesses are going to borrow and spend more. So we're going to see an increase in spending. What will happen to the rate of economic growth? Hey, if businesses borrow more money and spend it to buy capital, the economic growth rate is going to increase. They'll have the ability to make more in the future. Assume that the real interest rate of the Eurozone increases. Okay, so interest rates in Europe are going up relative to the real interest rate in the United States. So the United States is going to try and seek that higher rate of return. We're going to try and buy their financial assets. Draw a curriculum level graph of the foreign exchange market for the euro. Okay, so if the Americans want to buy the bonds, those financial assets that have a higher rate of return in Europe, Europeans aren't going to accept our dollars. They only want the euro. So what are we going to have to do? We're going to have to exchange it. The Americans will have to supply their dollars and then demand the euro so that we can buy the European bonds that have the higher rate of return, the higher interest rate. So the demand for the euro is going to go up, and that's because Americans are going to seek that higher rate of return. We'll have to supply our dollar and then demand the euro. When you demand something more, that means it's going to appreciate in value. So the value of the euro is going to go up, and in comparison, the value of the dollar will be depreciating. Assume that the United States current account balance is zero, okay? Based on the change in the value of the euro identified in part D2, will the United States current account balance now be in surplus, be in deficit, or remain at zero? So we said the value of the euro goes up, the value of the dollar goes down. So our stuff is going to seem cheap. As our stuff seems relatively cheap to the Europeans are going to want to buy more of our things. As they buy more of our things, that means the U.S. is going to export more. As we export more to the Europeans, that means our exports go up. Our current account balance becomes more positive. It goes into surplus, and that's a positive thing. Our net exports go up. Remember, current account is nothing more than our imports and exports. Exports are positive. So if our stuff seems cheap because the value of our currency has gone down, foreigners will buy more of it. Current account increases, and we're good to go. Moving on to question number 2. All right, so we got a PPC here. The graph above shows the production possibilities curve for Fisher land, the production of which of the following exhibits increasing opportunity costs: consumer goods only, capital goods only, both goods or neither good. All right, so we have here the production possibilities curve shows the initial trade-off between the two, and you can see that as you shift from capital goods over to consumer goods, you're going to be trading and giving up as you go from, say, like down here. You give up the opportunity of creating capital goods and you shift over to consumer goods. Or if you were producing up here and you shift in the other direction from consumer goods down to capital goods, you're giving up consumer goods and you're making more capital goods. So either way you shift along the curve in either direction, you can show that there is a trade-off between these two, and that is an opportunity cost when you have to give up something in order to get something else. So the answer here is going to be both goods. All right. Redraw the graph given above. Show a point that represents fully employed and efficiently used resources. Okay, so if you're fully employed, you're making as much as you possibly can. Efficient use is going to be somewhere somewhere on that curve. Efficient use of resources, you kind of have a little bit of a mixture of those two there. So it's going to be somewhere in that zone along here. But anywhere on that curve means that we're at our full production. If it was somewhere inside, if there was a dot inside, that would mean we were in a recession. And if the dot was outside of that curve, it would mean that we haven't quite been able to reach it yet. We don't really have the capital to get there just yet. If we had more capital, we had more efficiency, we could eventually get there, but we can't get there yet. Please note that a dot outside of the curve does not mean inflation. It doesn't mean inflation. This graph doesn't show price level or inflation. It just means we can't reach there quite yet. All right. C, assume there is a recession on fish land on your graph in part B. Label as C a point representing, so a recession is just anywhere inside that curve. Anywhere works. Identify a fiscal policy action. Okay, so action is either your government spending or tax change. It is not expansionary or contractionary. So you got to say, are we changing taxes or are we changing government spending? All right, identify a fiscal policy action that fisherland government can take to address this recession. All right, so to get out of a recession, straight from the flow chart here, you could either increase government spending or you could decrease taxes. Remember, if you decrease taxes, people have more money, so they'll increase consumption, which is a component of AD. So either increase government spending or decrease taxes. Part E, assume instead that no discretionary policy actions are taken. Okay. Will the short-run aggregate supply increase, decrease, or remain the same in the long run? All right, so if no policy actions are taken, eventually the economy always comes back to equilibrium. So if we're in a recession, that means workers are just grateful that they have a job. They're not going to be asking for increase in wages. So in a recession, wages of workers are relatively low. With low wages of workers comes a lower cost of production. If there's a lower cost of production, this means that aggregate supply will increase and shift to the right, bringing us out of that recession and back to equilibrium. So AS will shift to the right because of the lower worker wages in that recession. All right, so that answers 1, 2, and 3. Oh no, excuse me, that was just 1 and 2. Moving on to 3. Sorry, guys. Number 3, inflation and expected inflation are important determinants of economic activity. Draw a correctly labeled graph of the short-run Phillips curve. Okay, so Phillips curve, we have inflation on the vertical axis, inflation rate, and then we have the unemployment rate on the horizontal axis there. Many of you guys probably have the vertical long-run Phillips curve. That's great if you have that. The vertical long-run Phillips curve would just represent your natural rate of unemployment, which is around that 4% or so. All right, using your graph in part A, show the effects of an increase in expected rate of inflation. So if inflation is going up, you're going to see that kind of upward. This looks more lateral to the right, but it's going to be kind of the whole upward shift of it, of the whole curve. So there's more inflation, the whole curve is going to shift kind of up. Yeah, up is more realistic. They're showing it to the right, and to the right is correct, but it would go, kind of from here up to here if you had that long run Phillips curve. What is the effect of the increase in the expected rate of inflation on a long run Phillips curve? So if we have inflation, the long run Phillips curve, which again we stated was the natural rate of unemployment, isn't really going to be impacted. Just because inflation went from 2% to 4% doesn't mean that frictional unemployment changes. Doesn't mean that structural unemployment changes. If we see that inflation drops from 8% down to 5%, it doesn't mean that the blockbuster manager gets their job back. So your structural unemployment really isn't going to change. That natural rate of unemployment isn't changing. Given the increase in the expected rate of inflation from Part B's, will the nominal interest rate on new loans increase, decrease, or remain the same? Okay, so this brings us back to that formula where nominal versus real. So nominal equals our real plus inflation, that expected inflation. So nominal equals real plus expected inflation. So we can see here that when you have inflation going up, your nominal interest rates will increase. The real interest rate, what will happen? Will real interest rates on new loans increase, decrease, remain unchanged? Real is adjusting for that inflation. So when you take the inflation out of it, real is just going to kind of remain the same. It's not going to move anywhere. So real equals nominal minus the inflation. So once you take the inflation out and you subtract away, real isn't changing at all. Let's see here. Assume that the nominal interest rate, okay, nominal equals 8. Borrowers and lenders expect the rate of inflation to be 3, okay. And the growth rate of real GDP is 4%. Oh, they're throwing in this extra information just to distract you. That distractor information. So we already know the formula here. Nominal, which is 8. Nominal equals real plus inflation. So nominal equals your real plus inflation. So we can simply say that if you, to find the real, you can just take your nominal, which was the 8, minus the inflation of 3 to get your 5 of real. All right, that's questions 1, 2, and 3. Hopefully that helped you guys out. All right, take care. Bye. Let's pause that.